Hello, hi everyone. This is Cheryl. I let her be walking, and I'm back again with another video. I want to say welcome to my channel. Um, First, I want to show you all. Uh, it's just a chart. Not a chart, but sort of like a diagram that I created. This is this is like just some transactions that I looked at a book and I ran across. So, and it's for uh, Tech, Cheryl's Tech Firm, LLC. So, so when it starts out with, all of these are T accounts. In other words, uh, I invested 9,000. I invested 9,000 in my business. So 9,000, I would debit my cash account and credit owner's equity. Then I come over here and this is purchase 2,500 uh, purchase $2,500 worth of computers. So in other words, since I did that, so in other words, once you start, since I started over here with cash that I debit, so as you go down the as you go down and through the process, in other words, cash is already established here, 9,000 that I started my business with. I invested in the business. So then I come over here and I took $2,500 out because I bought some computers for the company. So you still see the 9,000 over here, my initial investment, and 2,500 for the computers that I purchased. And then I came over here and made another transaction, another business transaction, purchase equipment. So you still see the 9,000 initial investment. So that's a debit, 9,000. So now we're on the credit side. So purchase office supplies, 56,000, and this is the initial 2,500 that was taken out in the previous transaction, and this is 56,000 for the office supplies. And then I come over here, and then I have another transaction right here, purchased on credit, law library items. So let's want to debit law library. Then you got equipment. Since it was a purchase on account, that was a credit to accounts payable. And then I have another transaction over here where this is completed legal work and obtained cash. So legal work, obtained cash, 2,200. So this still, now we started out with a $9,000 initial investment, and this is 2,200 cash for the legal work performed. They paid 2,200 in cash. So this is that's the legal fees, right? Legal fees, the legal fees that had to be paid 2,200, and so that's the 5,600 that was in the previous transaction. So then I come down here and then I have paid office rent. So in other words, paid office rent, office rent right here, paid office rent right here, credit cash right here, paid office rent. These are the items that were paid out. They were credit to cash, 2,500, 5,600, 1,000, and office rent is over here. So no, this is rent, right? This is rent. This is the office rent, but it's taken out as a rent expense, so it's a debit to rent expense. And then we come over here to secretary, pay the secretary's salary. So this still, that's the 9,000 in cash, the first transaction at the top, the first initial transaction right here, 9,000 in cash for the investment. So it's still down here, seeing the cash, 9,000 debit cash, and we come over here, and these are the items that were taken out of cash in the previous transaction. So we credit cash for a decrease, debit the cash for increase. Then we come over here, the secretary's salary was paid. So your debit salaries expense, the debit salaries expense 700, and the last one over here is completed legal work on credit. So legal work on credit. So legal work on credit right here. That's 1,700 accounts receivable and credit to legal fees, unearned legal fees, and then 1,700 for completed on credit. It was on credit 1,700. So then once you, in other words, once we do all those transactions, once the company does all those transactions, then they come over here. So in other words, the Cheryl's Check LLC, they want to start posting to the ledger. So what they doing, what a company does when we post to the ledger, you look at all your assets, all your liabilities, and then over here, all your owner's equity. So then add all your assets up together, you get your balance over here, and then see these are your assets too. You got your accounts receivable, office supplies, law, you got your law library. So total all that up. And then over here, office, also you got your office equipment at the bottom. Total all that up. And you come over here, come over here, you have your liabilities, because this is the initial assets equal liabilities plus owner's equity. So this is how they post everything to the ledger. You got your accounts payable, your debits and your credits. See, everything is built around these T accounts, as I've always been saying. And your owner's equity, everything is debits and credits, owner's equity. Remember the 9,000 that we credited in the previous transaction. And then we got our withdrawal, debit withdrawal, our legal fees, rent expense, and then you have your salaries expense and your utilities expense. So your cash, your asset cash, assets cash. So everything is added up. So that was from the previous transaction. So in other words, the ledger came from all these previous transactions that we went over. First initial 9,000 invested in the business, and then we went on to all these transactions. So once you see, this is T accounts. Once you do all the transactions, and then all these transactions, so all those transactions, and as I said, then you post to your ledger account for your business. It's a ledger. Add all your assets, all your liabilities, and all your owner's equity. And that's how our company do. This is what they do when they do their ledgers. So they get the balance. Get your balance over here on the left hand side on your assets. Because initially, as I said, whatever side you increase your T account on, that's where you put your balance. So balance for your cash assets. Okay, so then also class, I just have some terms to read. Okay, first term I have is board of directors. Board of directors, they set the policy for corporations, and the board of directors, they're usually elected by the stockholders. So I guess usually they may have some type of meeting, and then they may elect their board of directors. So that's what they said. They set the policy for corporations elected, and they're elected by the stockholders. Then we have the bylaws. The bylaws are constitution for governing a corporation. So in other words, those are the laws that, in other words, if you form a corporation, you go down there and achieve your articles of incorporation, and that way you'll be incorporated, and you have to go by the bylaws. Then I have copyright. Copyrights are exclusive rights to sell, reproduce a book, music, uh, I guess that's composition, film, or art. And as I said, I have books that I wrote, and these are my books that I wrote. So I had to get my books. Uh, I had to get my books copywritten. So that's the back of the book. That's the back of the book. That's the back of the book. And also, it's the front of the book. And also to look inside the book. That's what the book looks like inside. So, and also, that's the inside of the book. So I also have me I do have a copyright page, copyright page. So my copyright page is right here. That's the copyright page. Copyright page. So as I said, it's another page for the inside. And you can pick these books up. They're written by me, Cheryl Hubbard. You can pick them up in the Google Play Store on the ebooks. And I also have another book I wrote called My Brother Billy is Different. And this is Since We Are Twins. And the other book is right here. We Have Autism. So you check these out in the Google Play Store on the ebooks. So that's the inside of this. All three of my books on autism. So they're just little story books for children to read. And yes, they're story books. Just little story books for children to read. Just something to improve. Also, it would definitely improve when they're reading. So if you can check these out. And We Have Autism. And so that's the book. And then I have another book, My Brother Billy is Different. So check any one of those out in the Google Play Store. So let me see, I have whatever terms I have. Also, I have materials, inventory, materials on hand that are intended for use in the manufacturing process. Materials on hand that are intended for use in the manufacturing process. So in other words, if you have materials on hand, say for instance you need you making, as I said, pocketbooks, whatever you're making, fur coats, pocketbooks, computers, and you have everything you need, materials on hand. So that's materials inventory. That's the inventory that you're about to use to make whatever product you want to complete. So in other words, like I said, you making fur coats, you're making pocketbooks, you're making jeans, or whatever you need to whatever inventory you need to make those products. So you might need material, thread, whatever you may need. Computers, you need your CPUs, your motherboards, your monitors, keyboard, for the computers. And pocketbooks, you may need your materials, your thread, the inside lining, or whatever you may need. That's materials inventory. Then we have market value. The market value, price for which a person could buy or sell shares of stock. So the market value, the price for which a person could buy or sell shares of stock. So in other words, if you're interested in buying some stock and you're looking at a particular company, Microsoft, say for instance, Amazon, Microsoft, Target, Kmart, Walmart, any of those places that you want to buy stock from, then that's you would have to buy it at the price that they set. So whatever price that the customer is willing to pay, then that's what you're willing to pay because they already had their prices set. So it's not like they're going to change their prices for you. So in other words, a market value. So the price for which a person could buy or sell the shares or stocks. So in other words, you buy it, you might decide somewhere down the line, you might want to sell your stock. So I guess you'll set your price for what you want to sell it for. Okay, okay. So let's look on the back. The next one I have is corporation. A corporation is a business owned by the stockholders. It's basically a legal entity, an artificial person. It can sue and it can be sued, and they can hire employees, own assets, and pay taxes. So in other words, if you form a corporation, you are a legal entity. You can sue, you can be sued, you can hire employees, own assets, and pay taxes. In other words, you just like it's a business. You're a business because you can hire employees, you own assets, and you pay taxes. You have to pay taxes on that corporation. So I think a corporation can have two or more members. So then we come down to owner's equity. Owner's equity, the claim is the claim of the owners of a business to the assets of the business. So owner's equity. So in other words, if you own a business, you have a claim to the assets. You own the assets. So it could be you might not be the only owner. It might be 4 or 5 other owners in the business. So you all will have a claim to the assets of the business. So then I have accounts receivable. Accounts receivable receivables are promises to pay. So in other words, you go to a company and you decide you want to purchase some, say for instance, you want to buy some backpacks, and you say, I want to, I want to sign a note payable. I need 1,000 backpacks for my school that I work for, and so you promise to pay. You sign a note payable, and that you're creating accounts. Actually, you're creating accounts payable. You will have to pay, and the company will be creating accounts receivable because they'll be receiving the money from you. So in other words, you go in there to purchase these book bags and you want to say 1,000 of them. So that means you have to pay for them. You will be creating accounts payable and the company will be creating an accounts receivable. So, and then another term I have, the accounting cycle. The accounting cycle is a process in which a company provides financial statements. So, in other words, the accounting cycle. It's a cycle in which in other words, it's time to get your paperwork in order a certain day and time. In other words, you have to have your income statements, your balance sheets, and your statement of owner's equity prepared at a certain time. Because auditors might be looking at your company for that paperwork, or it just might be the end of the accounting cycle. So, see the process in which a company provides financial statements. So, and also, you want to make sure that your statements, your statement of owner's equity, your balance sheet, and your statement of cash flows, and your income statement, you want to make sure your paperwork is accurate. In other words, you have to make sure your debits and credits are in order, your accounts receivables, your accounts payables. In other words, you got your income statement, your assets, and income statement, your revenues minus expenses. That should be on the income statement. All those figures that you have, all your revenues coming in, all your expenses, you want to minus your expenses off your revenues, and you want to make sure your paperwork is accurate. And your statement, you want to make sure your income statement is accurate. The figures have to be accurate. Everything has to add up. They have to match. All the debits have to match the credits. And then you have your balance sheet. Your assets equals your liabilities plus your owner's equity. So in other words, all your assets, you add all the assets up for that particular accounting period, and then equal, when the equal sign is in the middle, you say, I want to add, then I have to add up all my liabilities, add those up, and add up your owner's equity, and add your liabilities and your owner's equity together, and that's going to give you the total, which should match your assets. So assets equal liabilities plus owner's equity. And we come over here to accrual-based accounting. That means when you record your figures for your business, in other words, you buying equipment, you have to record. See, it said it records impact of a business as it as it occurs. So in other words, um, whatever you pay for, whatever price that you pay for your equipment, that is the amount that you have to put down. So in other words, it said records the impact of a business as it occurs. So whatever impact, whatever transactions that you make that impacts your business, you have to record it as it occurs. Accrual based accounting. And accrual revenue, that means it's something just keep on adding up, but hasn't been paid yet. So accrual revenue. In other words, you earn revenue that's been earned but not yet received. So eventually you'll be probably getting a accounts receivable once they start paying. So in other words, accrual revenue, they hadn't paid it yet, but in other words, you earned it, but you haven't received it yet, and everything just keep adding up. So eventually you will receive it as a part of accounts receivable. And then I have accrual revenues earned but not received. So, oh, okay, I already put that. That's the same one. Accrual revenue. Right, that's the same one I just mentioned. In other words, you earned it, but you haven't received it yet. Let's say, for instance, uh, you perform services for a client, legal services. You performed, I mean, you went to 4 or 5 different apartment complexes, and you painted about 100 apartments, you and your staff. But y'all haven't been paid yet. So that's accrued revenue. You earned it. You paid it. You went in these apartments and you painted. You and your crew and your team. You all went there and painted over a 5-day period, and you earned the money, which was about say $10,000 because y'all painted a certain amount of units, but you hadn't received the money yet. So eventually, your company will receive an accounts receivable from that company that you did from that complex where you went and did that painting. So, and you got accrued expenses the next term, incurred but not yet paid. So in other words, you created an expense, but you hadn't paid it yet. Whatever expenses incurred but not yet paid. Say for instance, you have a rent expense. You incurred a rent expense, and you went to your expenses probably would be like your rent and maybe your electric and your gas. So in other words, you're using up your space where you live at, but you hadn't paid your rent yet. Or you're using up your electricity, but you hadn't paid it yet. So you created an expense, but you hadn't paid it yet. You're using your electric every day. You in your apartment or your house, but you're using up the space for that particular expense, but you hadn't paid it yet. So that was that. I think that was the last one. Oh, let's see. Oh, I think I got a couple more. Okay. Manufacturing overhead. So manufacturing overhead, all manufacturing costs besides direct materials and direct labor. All manufacturing costs besides direct materials and direct labor. So manufacturing overhead is, in other words, you rent in a warehouse, and that's where you house all your inventory. So that's where you house all your inventory. So you have to pay your rent. That's your overhead. You have to pay your rent. You might have to pay gas. Whatever bills you have to pay for that warehouse will be your overhead. Anything that's not directly related to the making of the product, that's what they call overhead. So in other words, if you making, like I said, I'm making jeans, I'm making fur coats. So anything that's not related directly to making that product, the product that I'm creating, that I'm trying to put in, out for production, that comes under manufacturing overhead. In other words, direct materials. In other words, my fabric, my uh, I guess my fabric and my lining, that would be considered direct materials because that goes in directly. That's going to be used directly in my in the production of my of making my products, my fur coats, my jeans, or whatever I'm making for sale. And direct labor is right everything that's directly related to the labor, the making of the products. So direct materials and direct labor. You have to put the labor in. It's just like the assembly line on cars. We learned about that years ago. The assembly line when they're making cars. In other words, they have 10 people out there. You have one car. You have maybe 4 or 5 on one side, 4 or 5 on the other side. And as the cars go past, each person put on a part, put a part on the car that's related to their job, or I guess whatever the manager assigned them to do, whatever product, whatever I guess part for the car. You can say it that way. I can say it that way. That they were told to put on. So that would be a direct material because going down the assembly line and the cars passing by and you putting the car together as it go past, each person putting on a different part until it's assembled, just like a computer. Uh, uh, all the parts that go into a computer. It would be direct materials. My keyboard, my monitor, my motherboard, all those things, CPU, those are directly related to the making of the product, which is the computer. And like I said, the car, the assembly line, making them cars. So, then the last one I have is my net income. So we did net income on the income statement. Revenues minus expenses equals net income. So net income, the excess of total revenues over total expenses. The excess of total revenues over total expenses. So that's your net income. So revenues minus expenses. Excess of total revenues. So in other words, you total up all your revenues and you're going to minus your expenses. So over total expenses. Total revenues, total expenses. So say for instance, my my revenues, I may have cash, sales revenue, interest revenue, uh, revenues. Revenues minus expenses. My expenses are my rent, uh, like I say, gas, water, expenses. I have to pay my employees, so salary expenses. I had to pay my employees. I had to pay my secretary. I had to pay my ghost writer. Whoever you have to pay is included, and it will be called considered an expense. So net income, excess of total revenues over total expenses. So then I want to talk about a little bit about accounting. In other words, accounting is the system that measures, basically the system that measures business transactions and gathers all that information from within a company and generates income statements, balance sheets, statement of owner's equity. So uh, accounting is, well, we have financial accounting and managerial accounting. So financial accounting is usually for um, outside, I guess I could say outside people like your auditors, your banks, your credit unions, your banks, your credit unions, your auditors. Then your managerial accounting. Your managerial account is for managers within the organization. So, in other words, you're running a company, or say, for instance, my company, Hubbard, Hubbard Sherrill, LLC. No, Hubbard Sherrill. I have a CPA. Publisher CPA LLC. So it's a certified public accounting company and it's a limited liability company at the same time. So um, that's my company and that's and I'm dealing if I'm dealing with managerial accounting, it's my company. So I don't necessarily have to be the manager, but if I'm the manager, uh, I would have to um, make sure my my internal financial statements are in order. In other words, I have to make sure that my paperwork is accurate. So 9 times out of 10, I have somebody working in the accounting department, and they will be the ones that make sure that income statements, balance sheets, statement of owner's equity are done on time at the end of the accounting cycle, and most importantly, accurate. Because we don't want to have nobody in our company that's cooking the books, putting down figures that doesn't match up, debits and credits don't match, didn't record accounts payables coming in right or the accounts receivables coming in, didn't follow the accrual based accounting, and didn't follow the rules, just didn't follow the bylaws of that particular corporation. Because it still could be a corporation even if it's an accounting firm. So they have to follow the bylaws. I just read that in one of the definitions. The rules of the corporation are the bylaws. So managerial accounting managers have to be the ones uh, that account for internal things within the organization, internal the paperwork. In other words, the accountants have to deal with that, but the managers are the ones that get things done through people. So the managers have to make sure everything is done. So that's the definition of a manager. They get things done through people. Manager, hey, you do this, you supposed to do this, you on this job, you the accountant, you in the accounting department, you over there, you the administrator, you the secretary, you're the legal representative. So managers have to be on top of their game. They get things done through people. They have to delegate, and they have to organize, and they have to make sure everything and everybody doing what they're supposed to do. And so then the financial accounting, as I said, financial accounting is for those outside of the organization or the company. So in other words, credit unions, banks, auditors, even the SEC, uh, Security Exchange Commissioners. So outsiders, in other words, if you want to, say for instance, your company want to expand or you want to hire more employees, you have to know how much money you have coming in, how much money you have going out. That's why the statement of cash flows and balance sheets, income statement, and all those statements are very important. So how much money do you have coming in? Are you making enough? Are your revenues exceeding your expenses, or are your expenses exceeding your revenues in your company? So, or are your assets, or are your liabilities right? And your assets, are your assets more than your liabilities, or are your liabilities more than your assets? Because those are the things that you have to think about. So once you look at your revenues minus expenses, which are those things are in the income statement, then you see your net income, and you know where you stand as a company, your financial standpoint, and your assets, your liabilities, assets equals liabilities plus owner's equity. So all of those things are things that you need to be looking at. And so hopefully when you're running your company, you'll have people that's in your company that's honest. And so when it's time to do that paperwork, they're not only honest, but they're reliable and they're doing their job like they're supposed to do their job. And all your paperwork is on time and is accurate, just in case you get audited. But not only that, you just want to know that you'll have that you're thriving. In other words, then if you are a company, any company you always want to try to do better than your competitors, because you want your competitor, you want customers to come to you instead of your competitors. You would try to drive uh, more customers to your company. So in other words, you running a company and a company down the street, you all selling the same. You all, in other words, company down the street, they do nails. They do nails, and and you running a company too as well, and you do nails. So what can you do differently than the company down the street that's selling the same thing or selling the same service that you're selling? So in other words, what can you do in your business that would be different and unique that can drive customers to your business? That's the idea of running a business. So in other words, I'm running a nail salon, Cheryl's Nail Incorporated, LLC, and I want to just step in the next. I want to step in the other nail company, just step in their business and see what they're doing and how they do business, how they treat their customers. All I got to do is step in there and just act like I'm coming to get my nails done, and just see uh, how they treat their customers, how clean their place is, or how just how they do business altogether. Just how they do business altogether. So when I see what they doing, and then I say, well, you know what? I can create something more unique than that. So I'm gonna try to drive more customers to my business. So and sometimes customers go to certain businesses because they may just like certain staff members, and they so used to going to being they so used to going and being waited on by certain staff members, and they like, oh, I like that person because they every time I come, they're very nice to me and polite. They speak, and they do great service. My nails are done nice. They last long. They look pretty. They uh that so it's a lot of things to think about. But I'm just thinking about the competitive advantage. I'm thinking about a competitive advantage, and because when you're running a business, then those are the things that you need to think about. So I think I'm gonna wrap it up, class. So I thought I'll just do a little thing, something a little different this time. And as you can see, my background. But I want to thank you for joining me today. And I want to try to improve on my channel and do some things that's different. So Christmas is in a few days, and that is my birthday. So my birthday is on Christmas Day. So I'm happy for that. And I haven't put no tree up yet, but I might um, I might run my video. I might run my video next time while I'm putting my tree up, or just have my tree in the background. So maybe the next day or so. But thanks for joining me today, class, and enjoyed talking with you. So leave me some comments down below, and um, leave me comments down below. So I'm just trying to improve on my channel and trying to think about different things that I can do. So different things I can do. I was just sitting down a little bit, so just different things that you know I want to do to improve my channel. So I want to say thanks for joining me today, class, and I hope to see you next time. Same place, same time, and don't forget, check out my books in the Google Play Store. And this is my third book that I wrote. Uh, yeah, my third book. My brother Billy is different. I got my brother Billy is different. That's my brother Billy is different. And so so there's just a couple of pages in the inside. So if you can check out just on the page, and it's a good read for kids. It can help kids improve, help your children improve. So in the Google Play Store, it's the back of the book, and I got um So the bottom it tells you about the author right here. So just yeah, this is showing the picture that's on the front. So I think it's a good read for the children. Nothing wrong with improving on the children's reading. So we have autism. See, that's me at the bottom of my name, and so I want to say, class, thank you for joining me today, and I'm going to get ready to get prepared for my next class, and I'll probably see you in my next video. So I don't know what kind of surprises I may have for you, what kind of setup I might have. So I'm just trying to improve on my channel. So I'm trying to do the best that I can. And say this picture is nice and clear. What I did, I changed my lighting, and I don't know why I didn't think of that in the beginning, but so what I did, I just do a little Dove soap on my face, and no makeup. So when you see me, I comes on here with no makeup, just a little eye, uh, just a little eyebrow, pencil, and I don't wear no makeup, no lipstick or none of that. So just come on here and try to just explain things the best that I can. So class, I'm in here today, and I'll see you on my next video. So I want to say thanks for joining me, and these are the little charts that I have. So I'll probably try to have more of these in my next classes. So I want to say, class, thanks for joining me, and I'll see you on my next video, and I really appreciate you watching, and thanks for all the comments, and thanks for the constructive criticism. So I know some of my other videos, they might not have been as clear because I thought about it and I said, wait a minute now, let me brighten up my room. So this is my room, and I said, let me brighten up my room, and so I can see nice and clear. But class, thanks for joining me, and I'm going to see you on my next video, and I really do appreciate you watching, and I'm hoping that you are learning something. So, but I'll be back. I'm trying to improve, and I'm trying to bring you great content in my accounting course. So you all have a good one, and take care.